Good afternoon, ladies and gentlemen. My name is Michalis, and I'm the market analyst here at HF Markets. And I'd like to welcome everybody to another webinar. Today's a very important webinar, very important live stream analysis of one of the most important events of the month. And it has been that way in terms of the CPI being the most important for approximately 18 months now. So today we're expecting a lot of volatility. It's going to be one of the main price drivers of the month. So what we're going to be doing today, ladies and gentlemen, is there's going to be three aspects and sections of the webinar. First, what I wanted to actually do is really start off with an introduction for individuals that potentially have never traded before, or maybe they've got only a limited experience, potentially never traded on the day of the CPI. So very quickly, since we've only got 9 minutes, I wanted to go through a very quick introduction to look at what is CPI, why is CPI important, why are we speaking about CPI today? And then the second section of the webinar, we will start to go into more detail in terms of what is released, what was expected to be released, and how the price of different financial trading assets, including US equities, European equities, commodities, and currencies, have of course reacted and are reacting. And potentially, if there is any types of signals, active signals, which are materializing from technical analysis, actually giving us indications on how it's likely to continue potentially to develop. So very quickly, I'm going to go through 2-3 slides as quickly as possible because I want to be in time for the actual announcement in 8 minutes time. So the first thing, and again, I will say again, these 3 slides are mainly for individuals which have never traded or have very little experience. And then we'll go to the charts and look at some more advanced aspects of the market for our more experienced traders. So first things first, what is CPI? Of course, the CPI is an abbreviation and it stands for Consumer Price Index. So it is an index. The name kind of gives it away. It is an index which is basically a basket of different assets which consumers are buying. So this is why it's known as Consumer Price Index. Now, what is the index actually measuring? Yes, the index is made up of multiple products, goods, and services which consumers are buying and using. But what it actually does is on a month-by-month basis, it will measure and track exactly how the prices of these assets are changing. What is the alteration? Are prices increasing? Are prices decreasing? Have they remained unchanged? Now, based on the price movements, it will actually give a total figure, a total single figure, which will state, based on this group of assets, this is how much prices over the past month have changed. So for example, if it's showing a plus figure, it means that prices have actually become more expensive. If it's showing a minus figure, then it is confirming that prices have actually declined over the previous month. Now, there is 2 aspects of a consumer price index. You have the standard CPI, which is basically a more vast basket of goods. So it includes more products and goods, and also includes some goods and services which are very volatile. So for example, food, alcohol, tobacco, and other products as well, which are very volatile. So when the Federal Reserve and when the government and when investors in general are actually calculating inflation, they will use the standard CPI because it's more vast and includes more aspects and includes more segments of the market. And of course, every individual, whether in the consumer category or whatever it may be, of course, is going to be purchasing food, drinks, alcohol, tobacco potentially. And this is included only in the standard CPI. Then you've got the core CPI figure as well. The core CPI figure is still looking at price alterations, but the basket of goods do not include some of those assets which are very volatile. Again, for example, like food. Now, some people may say to me, and I got this question last time, what is the most important out of the two? Because there is scenarios where, for example, the CPI is very high, but the core CPI is very low. What is the most important? What is going to have the biggest effect on the market? And this is something that I will be answering in a couple of moments. So let's go through the rest of this page, and then we'll go on to the next page and look at exactly why CPI is important, and not only why generally is important, but why is it specifically important today, because this is going to give us a good understanding of how it's going to affect the market. So as we stated on point number 4, the CPI is used to calculate the US's official inflation rate. Every country will have an inflation rate. Every country has a CPI. Today we're looking at the US's CPI release. The CPI report is released every single month without fail. The dates may slightly vary, but it will be released every single month. It's always been considered to be one of the most influential events, but over the past 24 months, it has been considered by most individuals to be the most important and the most influential. Whereas if we're looking back to 2020, 2022, actually the NFP was considered to be more important. We've got 3 more minutes and then we'll go to the live announcements. Everybody's really excited to see if the CPI is going to be higher, is it going to come in as expected, or if it's going to come in lower, because based on that, we're going to get an indication on potentially how the market is likely to react, if investors will hold on to their shares, if potential buyers will actually be prompted and convinced to look at the stock market, invest more into the stock market, become more exposed. We're going to look at these factors here. Now, why is the CPI so vital? Now, this may seem slightly difficult to understand, but there's really easy ways of looking at it. When you're looking at the CPI, like we said, you're looking at the price alterations. So in simple terms, the CPI is giving us the inflation rate. Now, this has an effect on every single tradable assets, whether you're trading a currency, a stock, even a cryptocurrency or commodities. All these categories, all these assets are completely different. The CPI, though, will affect every single one of them. And why is that? Because, ladies and gentlemen, when you have high inflation, for example, over the past 2 years, we have had high inflation. When you get high inflation, what it actually does, ladies and gentlemen, is it actually triggers consumers, so everybody who is active in the market and in the economy, to have less capital. They have less disposable income. Why? Because inflation is high. Everything has become more expensive, so they're not able to buy as much. So what this means, very simply, is that all these companies, such as Apple, such as Amazon, every single company out there is actually earning less. Why? Because consumers are not buying as much, to put it very simple. So what actually happens is consumer demand declines, which is not good for the stock market. And this actually creates lower investor sentiment, lower consumer demand. And what people actually prefer to do in these scenarios is to hold cash. And because of this, we see a significant decline in the stock market. And also, a lot of the time, we see more demand for currencies, which is why in 2022, we saw the stock market completely collapse, declined by 33% if we're looking at the NASDAQ. But we saw the US dollar become very, very expensive. Now, the next thing which I will mention is that because of this, because of high inflation, and we will go actually to the calendar, because of this, ladies and gentlemen, and you can see here the 4 events which are about to be released, ladies and gentlemen. You've got the CPI in terms of the monthly figure on our platform, which is why it's such a great calendar as well. It will also give you the CPI in terms of the yearly core inflation rate, and then you've got the standard CPI and the standard CPI yearly rate as well. Now, when you get high inflation, what also happens is the central banks will increase interest rates to try and bring inflation down. When interest rates are increasing, it means when investors are investing in the dollar, they earn more. So a lot of individuals, they prefer not to look at the stock market, but to rather look at the US dollar. Now, in addition to this, ladies and gentlemen, the cost of borrowing, and everybody who has a mortgage and a credit card also spends more on the credit card, on their mortgages, and so on and so forth. Now, because of this, again, they have less disposable income. They're less likely to invest. They're less likely to buy and be active in the financial trading markets. So this is also another factor as well. So let's refresh our slide so we can look at what is actually released today, ladies and gentlemen. Let's click on today and scroll down. Here we go. So what is released exactly, ladies and gentlemen? First things first, we've got the consumer price index, the standard consumer price index, which read 0.3%. This actually means, ladies and gentlemen, that inflation has increased higher than expected. It rose from 3.1% to 3.4%. So inflation is higher. So like I stated 10 minutes ago, even before the announcement was made, when inflation is higher, it pressures the stock market a lot of the time, potentially, not every single time, but a lot of the time. And it also increases demand for the US dollar. So in a moment, we will go onto our charts and we will see exactly what kind of an effect it had. But we can see here, inflation has increased at its fastest pace in very a lot of months. It's a strong increase as well, ladies and gentlemen. It's increased from 3.1% to 3.4%, which, as I said, is the highest uptick that we have had in many months. If just judging off the top of my memory, probably more than it has in over a year. If we're looking at core inflation, ladies and gentlemen, if we look at core inflation, it came in at 0.3%. 0.3% is as expected, but it's still negative in the market, ladies and gentlemen, because 0.3% from monthly price alterations is high. Ideally, individuals want it to be between 0.1 to 0.2, at a very max 0.2. So it's coming higher. And also, if we're looking at the yearly core inflation rate, it's not actually increased, it's just declined at a lower pace. So we were expecting it to decline to 3.8. It's declined to 3.9. So the Federal Reserve, stock buyers, and these individuals are not going to be happy with the fact that they're not applying enough pressure on inflation. So we've already stated, before we look at the charts, we've already stated that high inflation is negative for stocks, potentially positive for the US dollar. This is looking at the traditional domino effect of the market. Of course, the market is volatile. We need to look at each scenario individually, of course. The other thing that a lot of individuals wanted to get answered is, what is more important, the core figure or the CPI figure? Now, at the moment, it's not always the scenario, so keep this in mind. But at the moment, inflation is mainly being made up of core services. So the core CPI is extremely significant today because it's making up most of the inflation rate. Whereas if you were looking at a year ago, a year and a half ago, inflation was everywhere. It was in all segments, including food, especially in energy as well, and so on and so forth. At the moment, especially over the past 3-4 months, it's mainly in the core sector. So let's go to the market and see exactly how the market has reacted. This is a 2-hour chart. We'll come back to the 2-hour chart. The 2-hour chart is very, very important because it gives a very clear price sentiment indication, and the oscillator is extremely important as well. But we're going to come back to this slide in a moment. Let's go to our 5-minute chart. Ladies and gentlemen, look at this 5-minute chart. This, of course, keep in mind, I stated 10 minutes ago that high inflation is negative for the stock market if we're following traditional economics. This was before the announcement even happened. This was before we even put the charts onto our screen. And you can see now that the event has actually been released, in the 5 minutes, well, it's not even 5 minutes, in the 3 minutes after the announcement, the Nasdaq declined up to 0.79%, ladies and gentlemen, 0.79% after the announcement. Why is this the effect of the market? I'll explain very simply. This is the effect of the market, and individuals have obviously decided to sell stocks, and very few people are willing to buy stocks based on this price movement, because of course stocks are priced based on supply and demand, or if you've got some more experienced traders based on order flow, if individuals are also looking at order flow analysis, which is very helpful and accurate. This is because, ladies and gentlemen, inflation is higher. Now, what this basically means is the Federal Reserve is unlikely to think about cutting interest rates anytime soon. Why? Because the employment sector, like we saw last week, was very positive, resilient. Also, average hourly earnings was extremely high, and it is normally high in December, but it was again extremely high, which is something the Federal Reserve would not want to see, because strong employment, low unemployment, high salaries actually trigger higher consumer demand. And if you're trying to bring inflation down to where it should be, high demand is not something you want to see. In addition to this, now inflation is high. Inflation has increased. Core inflation has also not increased, but on a monthly basis is very high as well. So because of this, ladies and gentlemen, people are fearing a specific scenario. What is this scenario? People towards the end of 2022 really bought into the stock market because a soft landing scenario became extremely likely. But and what is exactly a soft landing scenario? It basically means that the economists in America, the central bankers, the federal government are able to bring inflation down without triggering a recession or significant economic decline. And that looks like it's going to be the scenario from what we saw towards the end of last year. But now, if inflation increases, like we said, it's going to lower consumer demand. It eats into everybody's pockets. In addition to this, it actually makes the Federal Reserve think about two potential outcomes. Outcome number one, we need to increase interest rates one last time, in which case that has definitely not been priced into the market over the past 6 months, over the past week, and so on. In another scenario, potentially, is that we don't want to risk making the market so restrictive that we hike interest rates again, but we're definitely not going to cut interest rates anytime soon. So because of this, ladies and gentlemen, we have seen a decline in the market. At the moment, of course, the market, like I said, it declined 0.79%. Now, though, we're looking at a decline of 0.42%. Now, I don't want people to think this is an upward trend, because that is not deemed to be an indication of an upward trend. Of course, individuals may believe an upward trend is going to form, and they may have their own signals for this, and so on and so forth, which is absolutely fine. But in terms of this upward volatility, it's not necessarily an indication of an upward trend in terms of price action. This is the traditional price movement after the announcement. Why? Because you get a lot of downward volatility, and because of this, a lot of people who are really started to sell and speculate a downward decline start to cash in as the price declines. People think about purchasing a discounted price, and so on and so forth. But it doesn't necessarily mean solely based on this that there's going to be an upward trend. So the fundamental side is still indicating a potential downward trend. Even in the past couple of in the past minute that I've said that, we've seen it's already started to decline again. Now let's go back to a 2-minute time frame, ladies and gentlemen. The 2-hour time frame. The 2-hour time frame has been indicating an upward trend since the 8th of the month. So 3 days now, almost 3 full days. Now, since that, ladies and gentlemen, we had an upward price movement of 2.36%. Now, 2.36% in a period of 3 days, not even 3 days, is a significant price movement. So this setup was very, very helpful. Now, at the moment, if the price, generally speaking, is above the 75 bar exponential moving average, then it's indicating that there's a strong price sentiment in the market. Now, if the price is below, it indicates a low price sentiment. So, of course, when the price is above, we're following the traditional usage of the 75 bar exponential. When the price is above, we're mainly looking at where there is potential to speculate and to buy and to trade an upward price movement. When the price is below, so for example, here we started to get indications that the price would decline, and it thereafter declined, ladies and gentlemen, by 3.90%, and it was declining up to so from the second all the way out to the very beginning of the end of last week, so approximately a week. So because of this, ladies and gentlemen, you saw, because of this price sentiment line, that there was indications that sellers will be controlling the market. And then you have the oscillator here. Now there's 4 zones to the oscillator. This is known as a relative strength index, which is an indicator. It's part of the category known as oscillators. When we're above 75, so if the blue line here is above 75, it indicates that the price is too expensive. And when the price is too expensive, the price can potentially change price movement, a different trend, or we may see what is known as a retracement or correction. A good example of a retracement is this here. It's a temporary downward price movement within the trend. So it's still an upward trend. Even after this downward price movement, the upward trend still continued, but we saw a temporary downward price movement for approximately, this is 2-hour chart, so approximately 10 hours. Now, because of this, if you're overbought, you can get a retracement if the indication is correct, that is. Keep in mind, it's only an indication. Or it can be an indication of a completely different trend. So we're not at an overbought price at the moment. The oscillators are actually pointing downwards, which is indicating at least short-term downward price movements. Then you have between 75 and 50. Now, if you're between 75 and 50, it indicates buyers are controlling the market. If you're between 50 and 25, it indicates sellers are controlling the market. If you're below 25, it indicates the price is too cheap. So ideally, we want a scenario where the price is above the sentiment line, and it's also above the neutral on the oscillator. Now, at the moment, it is above, but only 12 minutes ago, we had negative news for this asset, and it actually is causing the price to decline. So really, we need to be slightly cautious that it's not actually going to see a different scenario very soon. Because if, for example, it declines below this point here, ladies and gentlemen, we will then be trading below the sentiment line, and we will then be trading below the neutral on the oscillator as well, which is actually indicating a decline. Now, if we're going to follow trend ratios, trend measurements, and price action, the price potentially can, even if we're going to see a continuation of the upward trend, the price can potentially decline to this level here, ladies and gentlemen. For example, like here, when we got a retracement, it declined all the way back to the price sentiment line. So we're looking at target potentially number 1, if individuals want to speculate a downward price movement to that trend line. If it declines below it, then we can be looking at an actual downward trend. Now, if we switch on to a 5-minute time frame, ideally we want on the 2-hour and also on the 5-minute time frame. Also, I can see some questions. I'll answer these questions very shortly. I've got an individual who says the CPI release bored me tonight, which is actually very interesting because the CPI was extremely interesting. It was the first time in the past couple of months that we've actually seen the CPI very different to what was expected. So I'm not sure if it bored you or potentially disappointed you, because there's a lot of buyers that definitely would have been disappointed by this announcement. Now, here, though, ladies and gentlemen, we're looking at crossovers. We're looking at a 8-bar moving average. I've got another question here. Which pair is that? Here, we're looking at the US 100. So we're looking at the NASDAQ. This is basically a CFD, which is mimicking, following the NASDAQ as an underlying asset. Now, here we've got 2 moving averages. We have the 8-day, the 8-bar, which is the trigger, and then we've got the 16-bar as well. Now, the 8-bar is an exponential moving average, so I will actually show you this, ladies and gentlemen. So you can see it's 8 and it's exponential. And then you got the blue, which is 16, and it's simple. Now, because of this, it creates momentum and it creates crossovers. So for example, here we had a downward crossover. So you can see the orange crossed over downward after it crossed the blue downwards. Now this is indicating the price can potentially decline. Now the latest crossover that we saw was also a downward crossover at the announcement itself. Since the crossover, we've seen quite a strong downward price movement. The downward price movement that we've actually seen at the moment is again hovering at minus 0.43. So this is something for individuals to take into consideration as well. Now, something else that individuals can use to help them understand how the price of the Nasdaq is going to keep moving. You can, of course, use our sentiment line and the oscillator that we looked at on the 2-hour, and also on the 5 minutes as well, if we're getting crossovers. Ideally, you want a scenario where there's no conflicting indications. So, for example, the price being below on the 2-hour, for example, or should we look at the latest upward price movements? This is where we really started to see upward price movement here. So at 6 o'clock yesterday, this is a good scenario where we're in the 50 to the 75 region, so buyers potentially controlling the market, and above the 75 bar sentiment line. Now, if we switch to the 5 minute, we can go back to 6 o'clock yesterday. Bear with me. So let's find 6 o'clock on yesterday. Here we go. So 6 o'clock yesterday is where we really started to get indications, which is approximately here. So we want indication upward crossovers after that. So the upward crossovers next after that, we had a crossover here. And we can see since the crossover, we saw a big, strong upward trend here. So you can see you don't want conflicting signals. You ideally want all signals to be indicating a different direction. Then the next crossover we saw is here. So you can see again, the next crossover, not the downward crossover. You can see I've ignored the downward crossover because that's conflicting the 2-hour time frame, because it's indicating downward price movement, whereas the 2 hours indicate an upward price movement. And even when I keep on crossing, for example, here we get another upward crossover, we can see the upward trend continues. But now, though, ladies and gentlemen, it's a scenario where potentially we're going to see a different trend. Potentially, it's not guaranteed, based on fundamental analysis, because, of course, you've got inflation much higher than previously expected. So I've got individuals, we can look at gold. Is gold a buy or a sell? Before we start to look at gold, we'll look at gold as the next asset. I mentioned a couple of things which can help individuals determine if the Nasdaq is going to potentially move upwards or potentially move downwards. I'm actually going to show you it on Google, so it's easy for everybody to see. If you type in Nasdaq components, it will open this page here for you, and it will actually confirm from the most traded assets, from the index itself, the component, which is the most influential. So you can see numbers, it's here. The most influential is Apple stocks, the second is Microsoft, then Amazon. Now here, ladies and gentlemen, you can actually see that it gives you the performance of the assets. Keep in mind the market is still closed for another 40 minutes. Now once the market opens, this will be adjusted. Now if all of these are red, or if a vast percentage of them are red, it's indicating that the most influential stocks are struggling. So you can take that into consideration as part of your analysis. If all of them are green, then the most influential stocks are performing well. So again, you can take that into consideration. So let's now go on to gold. Bear with me. Let's add gold onto our screen. Here we go. So here we're looking at gold against the US dollar. We spoke about gold actually as part of our analysis over the past few days, and we stated that it's finding resistance at this sentiment line. This is another scenario today as well. So found resistance at that sentiment line here on the 9th of the month. It found it again on the 10th of the month, and it found it again today after it started to decline. Why is gold declining, ladies and gentlemen? Because interest rates are now likely to stay higher for longer. There is potential, it's not guaranteed, but a lot of people are going to be thinking about if there's actually going to be another interest rate hike. If there is, I don't think it's potentially going to be something massive because inflation hasn't got that far, but nobody actually knows. A lot of analysts will actually follow the possibility of there being another 25 basis points, which are the last interest rate hikes previously that we saw as well. The downward price movement is because of this, because interest rate hikes are likely to be higher for longer, which means it actually is individuals and investors are actually going to be pumping a lot of their capital into the US dollar, and it is strongly inversely correlated with the dollar. But here we've got indications that the price of gold is going to decline according to these indications here. So we're trading below the 75 bar moving average, and we're also now trading below the oscillator. Now, if the oscillator declines below 45 as well, we're very close to that, and we also get lower lows, then again, these are even more indications that the price is going to potentially decline. Let's look at the 5-minute time frame as well on gold, so we can get more intraday indications. So here, ladies and gentlemen, you can see the latest crossover here is a downward crossover. We've crossed below previous lows. And also, if we look at the MACD is in the negative, and each bar is showing higher volatility as well. So this is another indication as well. So again, indicators so far at the moment is downward price movement. But keep in mind, and as you can see here anyway, there is a lot of volatility. I've got a question here from somebody, how to pinpoint and be more precise with their entry. What you can potentially do is enter a pending order, which is basically something that you personally preset. If I see that much momentum downwards, then it's enough momentum for me to want to enter and believe the market's going to decline. So for example, you could put a point here that if it declines and crosses below that, to automatically enter a sell speculating a downward price movement. How to do that? You can just right click and you can see trading here. You've got a sell stop and others as well if you wish to open other pending orders, such as a sell limit, a buy limit, a buy stop, and so on and so forth. But indications here for gold is still a decline, but keep in mind a lot of volatility there, ladies and gentlemen. Something which is going to be key for gold as well is the US dollar index. People also have access to the US dollar index. Look at the US dollar index, ladies and gentlemen. It's just shot upwards. We can only see green. It's not anything like gold, where we were looking at both up and down price movement. So you can see here, there's green and red as well. Whereas when we're looking at the US dollar index, ladies and gentlemen, it is pure green, pure upward price movement. If we want to know exactly what the upward price movement has measured, if we're looking at the price before the announcement, it's increased by 0.47%. So a significant price increase, ladies and gentlemen. Now, if people want to trade, they of course have access to the US dollar index as well. If you want to trade a currency pair though, rather than an index, a lot of people turn to the euro against the US dollar, not because it's the best pair out there, but it tends to have a lot of volatility and it tends to have the lowest spread as well a lot of the time. And you can see, since I've been saying that, it's just declined to a lower low. Indicators here, ladies and gentlemen, latest crossover is downwards. That is the latest crossover. I've got a question here. How do I learn about analysis? I don't understand analysis. What you can do, ladies and gentlemen, is just go to Google, type in HFM analysis, and there's a lot of educational material in terms of indicators. We've got live analysis every single day as well, released every morning about the market, what is affecting the market, and so on and so forth as well. So here now, if somebody doesn't want to wait for the next crossover, what they can potentially do is switch over to a 1 minute time frame instead. So here we've got a 1 minute time frame. It will have an upward crossover before the 5 minutes. So if individuals want to speculate decline, they can wait for the upward crossover and then follow on the next downward crossover. Other thing individuals can do as well, if they wish, is they can look at the next breakout point, which is here at 1.09349. So this is also something individuals can take into consideration. The US dollar is increasing against most likely all currencies. Let's look at the US dollar against other currencies as well. If we look at the US dollar against the Australian dollar, we can see it's moving in favor of the US dollar. If we look at the US dollar against the pound, look at today's price movement, you can see the same. Also opened on a negative price gap. This is something we haven't seen yet. So you can see the price was up here, but then it opened all the way down here. So it opened 0.18% lower. So that indicated nobody was willing to buy in that gap there. So it just dropped to a lower low straight away. So that's something very interesting as well. Here you can see the US dollar increasing in value again. Not to the same level though as the Euro USD, which is declining at a larger and more fluent level. Then also an asset which is quite popular is the US dollar against the Japanese yen. And you can see the US dollar against Japanese yen has just completely shot up. Again, a lot of upward momentum and volatility here, ladies and gentlemen. If I measure the price movement, we're looking at almost 0.60%. So a lot of upward price movement. And you can see the MACD is extremely high, and you're looking at higher and higher bars as well. So again, here we're looking at indications of upward price movements. So I've got some questions. Let me quickly answer these questions as well. Which oscillators are you using? So here I've got the MACD, and on the 2 hour, this setup, which is a very well-known setup for price sentiment and indications of whether buyers and sellers have control over the medium-term market, the short to medium term, because you can see this is giving us the price movement of the month so far. We've got the relative strength index, which is the oscillator, which is this here, and we've got a 75 bar exponential moving average, which you can see here as well. If we're looking at the oscillator on the 1 minute or the 5 minute, which I was showing before, this is a MACD. So if you go to insert, you go to indicators, you go to oscillator, you can see there's a MACD here. And you can see the relative strength index, which is what we were looking at on the 2 hour. If you want to get access to moving averages, you go to trends, and you've got moving averages here. So you can see HFM offers so many different indicators. All of them are available to you for free. We also have more advanced indicators, such as, and a lot of calculators as well, which you get access to once funding your account as well, such as auto chartist indicators, which are exclusive. They're not available, generally speaking, within the market. Is the CPI going to affect gold in the long run? Yes, it will affect gold in the long run, especially when I say long run, we're not talking about years and years, but in the foreseeable future, the CPI was extremely high. So yes, it is going to have an effect. Doesn't mean there's not going to be volatility or upward price movement. There's still going to be upward price movement, but it will still have that longer term effect on it potentially. What's going to keep the momentum and build the momentum, the downward momentum? Tomorrow we have the producer inflation rate. So today we had consumer inflation. Tomorrow we'll have producer inflation. If producer inflation also is higher than expected, again, that's really building a negative factor for interest rates. So interest rates potentially remaining higher, potentially even another interest rate hike being talked about on the table by the Federal Open Market Committee. So that's another factor as well. And you can see again here, ladies and gentlemen, US dollar is just climbing higher and climbing higher. If we go back to gold now, just to have a look at gold, what's happening? It's not gone to a lower price, but it's still very, very low. If we go back to the NASDAQ as well. So here, if we look at the NASDAQ, let's go to today. Again, very low. It's actually declining, trying to break that that support level and decline to a lower low again. Now, we've had consumer inflation tomorrow. Producer inflation really can build momentum if that's more than expected, and then people really start to look at comments from the federal chairman and members of the Open Market Committee. If they really start to indicate another interest rate hike is possible, then that's a completely different scenario to what was being priced into the market. So again, that's something really to take into consideration there. Let's see if there's any other questions. On the 2-hour, it's a 75 bar exponential moving average, just to answer your question. It's not a simple exponential moving average. So, ladies and gentlemen, that brings us to the end of today's live stream. If we don't have any more questions. So today we've got a good understanding of what CPI is and why CPI is so important. Before the announcement was made, we said what kind of effect it can have on the market. Today is one of those occasions where it had that exact effect that we spoke about. Inflation was higher than expected. The consumer price index came in as expected. The core consumer pricing came in as expected, but the yearly figure didn't decline as much as we'd hoped. So again, that's negative for the stock market, positive potentially for the currency, the US dollar, that is. So unless we've got any other questions, let's end today's live stream. In the meantime, ladies and gentlemen, trade safe, trade responsibly, as always. Enjoy the rest of your day. Good luck, and hopefully we will see you very, very soon on one of our webinars. In the meantime, we'll see you very, very soon. We've got a list of all our webinars which are upcoming for the rest of the month, which are free access to everybody, free educational material. You can view that by visiting HFM's website. In the meantime, though, enjoy, good luck, and take care. Goodbye.